Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted today to be able to speak to CEO Shanker Patel of Lords Group Trading, a leading buildings merchant and heating products distributor. So welcome, Shanker.
Thank you, Paul. It's good to be back after a short recess.
Yeah, that's right. Well, big congrats on today's resilient year-end trading update and sort of considerable cash generation in the second half, where I think actually you generated £9.5 million of extra cash flow to bring net debt down. But before we sort of dig into the details, I don't suppose you could quickly provide a bit of colour on the health of the building products industry in the UK at the moment.
Well, look, we've always maintained that this is a very large industry. The addressable market is in the sort of 50 odd billion. We've got a very small share of that market. So whilst it's widely reported that the market has been subdued, interest rates, cost of living pressure has impacted certainly the new build market and elements of the RMI market. But for us, well, what we see is that those subdued markets are not going to remain subdued forever, right? They've had a considerable amount of external shocks, considerable amount of macro shocks, and especially with interest rates and inflation. And what we're now starting to see is as people normalize to a slightly higher interest rate, slightly higher inflationary environment, the investment in buildings, the requirement to build new houses, the repairs of existing housing stock, which is still very old and in need of modernization, those markets will start to come back. And so we see the outlook for the future being positive, whilst it will still be intermittent before it starts to take off due to a lot of factors, such as interest rates remaining high. We need some government incentive. There's an election year. Supply chain issues from the Red Sea now have sort of started to appear, and these sort of small and large shocks do affect markets. But we remain very confident that the market is extremely large, and our opportunities in the fact that we're gaining scale, but we're still very small.
Yeah, no, I mean, and there's millions and millions of properties, certainly just around where I live, who with an modernisation. And if we do get a sort of change in the government and Labour come in there, sort of like one of their central policies is to step up the house building programme from, I think, from 200,000 units a year to about 300,000 or more. So yeah, and I think also if you look at this sort of interest rate curve, we are seeing the markets expecting a percentage decrease in the bond yields, which should obviously drive mortgage availability and sort of the affordability.
So transactional activity in the new build market needs to start showing signs of coming back, into growth territory. You've got forward interest rates looking a lot better than in the last sort of 6 months. And even in the interest rate environment, it's dependent very much on the market's perception of inflation, and wrong figures 1 month can lead to people reforecasting what will happen with interest rates. But certainly it appears to be the case that they're not going to be on the rise. Can never rule that out. It seems that it's not going to be. And I think there is a degree of stabilization when interest rate perception is that they're now not going to increce.
I can't see.
So that'll start to feed through.
Yeah, I can't see Liz Truss winning the election anyway, that's for sure.
She's put her hat in the ring. She should have another go. Why not?
So before the sort of conditions do arise, how is the business sort of like managing itself? I did notice, obviously, a real feature of the statement today was the resilience and sort of cash generation, and also sort of like economies of scale in terms of generating greater operational efficiencies and savings.
Yeah, so hard environments and rapidly changing environments. So whether you call it a crisis environment or a turn in trading over a very short period of time, these are the sort of conditions within which we've always operated, and actually not just operated. These are the conditions where, as a business, we really prove our differentiation as a management team, as a business, through our colleagues, as a culture, through how we support our business and how we manage it. So we're doing exactly what we've always done. In tough environments, we roll up our sleeves and we start to really make sure that we're ahead of the curve in areas where we need to ensure we protect our business. So debt reduction was something that was flagged up at H2. We made it very clear in our interim results that we will get it down. There were some very clear reasons why it had shot up around the boiler supply issue, and therefore we expected the normalization of that working capital and the stock levels, and we're really pleased that we managed to deliver that. But it's delivered because we've had a focus on it. We're relentless in ensuring that that when we say we're going to do something, we ensure that we do it, and cascades right throughout the business. In terms of cost management, again, we've had a really hard look at that, and where we're slightly different is because it's a customer service and a customer experience led business. We have got to make sure that we manage that delicately, because the last thing you want to do ultimately is go to such an extent where your customer service or your capacity suffers. And that's the interesting point. What we've been also doing, especially since we've listed our business, is that we've been building capacity in our business. In our central functions, we've got some really great people that we've hired. We've got a group HR director that came on last year. Now these are investments in people, investments in systems that we're making, such that the business can cope with greater volume when the markets return. So embedded in what we've been doing in 2023 is really investing in our infrastructure, investing in the very foundations of our business, and it's of course it's a cyclical business. We totally get that, or the market is. But when you look at our performance and compared to our peers, I think it shows real resilience. An overall level of sales growth is tremendous, and my absolute credit to all of my colleagues that we finished the year in green.
Yeah, no, absolutely, and just to give a highlight to sort of investors on the net debt reduction, that it's gone down from about, I think it was in June, about 38 to 28.5 million, and if you run the adjusted numbers sort of pre IFRS 16, which I tried to do on EBITDA, you get to less than 1.5 sort of leverage, which is very comfortable, no doubt about it, and is also backed up, I understand from the statement, with a 15 million pound freehold property as well, which sort of underpins that.
So we've always been very conscious that that whenever we've taken on debt, that the debt is actually backed by real assets, and that's something, again, when we were private businesses, you can imagine how I grew the business was to understand, what are the debt pieces for. And you can generally borrow money for working capital requirements, because every business has a working capital requirement, and therefore, various types of funding lines for working capital are available. So that's one piece of funding that we've always understood and used. But the other is for hard assets such as real estate. And capital efficiency dictates that in one way you can look at your real estate and say, why do you want that? That's a lot of cash tied up in property. But actually, we then cross from financial considerations of why do we have property to operating considerations. And in a high inflation environment, and especially with the kind of locations that we've gone in around the southeast of England, and when we're up in the Midlands or the North, we're in really good, strong locations. It's been a differentiator of our business. It is prudent to have an element of property so that you can mitigate your rent increase risk. Yeah. And when you look at the industrial sector, when you look at the distribution sector and warehousing, property in these sectors have risen, rents have risen appreciably, the values have also risen. Okay, so our job is to have that healthy mix, and the way we look at it is that with 15 million pounds worth of property, if we were to liquidate that tomorrow, we could, of course, quite comfortably pay down the debt. We would then be incurring rent, of course, as a consequence. But if we're really thinking about our debt and cash, what we're saying is that it's underpinned. There's a high degree of that debt that is underpinned by physical assets. Those assets, I'm hoping, would also increase in value over time, and they have. I can't think that in our portfolio, the assets that we've got would not be increased or have not increased over time. So it's a good hedging bet but of course there are going to be divergent views on capital allocation in in property. And we say that, you know, as an operator, we need to have a good mix of the two. Of course, we have too much property. That's fantastic. You won't have landlords to face, but you are tying up a lot of capital.
Yeah, I'd never heard of that. That's really astute, sort of like, you know, hedging on your rental risk. So that's great. Now let's just even though we've got sort of like more subdued, you are starting to see sort of growth in certain areas, the sort of renewable energies and the decarbonisation products. Do you want to take us through this, how the company's set up? Because yeah, I mean, just about every single home where I live in needs a sort of an air source pump or
an air source heat pump. Yeah. Well, look, this is an enormous opportunity. Okay. So it starts with the government and I think the society's aim to decarbonize homes. You know, heating of our homes using fossil fuels has very clearly been outlined as a major source of greenhouse gases, and government is doing something about it as part of its pledge. So they've come up with something called the Clean Heat Market Mechanism. It's here. It's now been made active as of the 1st of December. So pretty short notice, unfortunately. But the idea is that it is incentivizing manufacturers and consumers to install air source heat pumps, which are of course electricity based products, and that would heat your home. Now, what we see is that actually the manufacturers of those products recognize our plumbing and heating model plays a very big role, as we are a route to the market. So right now, boiler sales are around about between 1.4 and 1.6 million annually, including new build. If we're trying to get to 600,000 of that 1.5 million to be in air source heat pumps, those products need to be distributed. That's a lot of products. And that's where we come in. You know, we're part of that same route to market using our existing infrastructure. But where it's a commercial opportunity for us is that actually the unit cost currently of an air source heat pump is far greater than the unit cost of a boiler. And I think last year, over the last 2 years, in fact, whenever I've been asked about this, I said, look, as far as we're concerned, you know, number one, we're a business that sells product because we are product experts, right? So we have customer-focused product specialists. So we have people who will switch from understanding the ins and outs of a boiler to understanding the ins and outs of an air source heat pump. So when you want to buy one, you've got experts that you'll be talking to in our businesses who will be able to provide you with the solutions you require. We then have stock because we've got the warehousing, we've got the supply chain connection with the manufacturers, and then we also have the logistics, the ability to take the product from our warehouses directly to the consumer or to another merchant who is then going to sell it on. So doing all of that, what we're doing is effectively switching a box, which is called with a boiler in it, to a box with an air source heat pump. Everything else within our infrastructure remains the same. Of course, we have to train our colleagues and have a slightly different marketing angle and customer information angle on these products because they're not the same as boilers. But it's not a transformation of our business model. It's an evolution in the products that we now sell. So our approach to this is that we must embrace it. You know, it's here, it's going to grow, and we are part of delivering that growth. And the business is very clear that it will continue to invest in this technology, which affords us enormous opportunities. I said, you know, we're one of the largest boiler distributors. We intend to be one of the largest heat pump distributors and vendors.
Yeah, well, we might well be knocking on your door there, Shanker, in the next couple of years. We've had ours about 10, 15 years, and it's on its last legs. We've been running it like all the time during this last sort of cold snap. Just sort of top level. What's the sort
of colleague will be on his way in a minute.
Okay, yeah, I'll send over a purchase order ASAP. Just top level in terms of the synergies between the two sort of divisions, your building merchants and your sort of your plumbing and heating. Where do you see the synergies? Is it sort of like just a natural balance of that business, or how do you see it?
So they're independent divisions, and the greatest opportunity is to expand the footprint, broaden the product range, use data and customer insight,
Mm.
because effectively they're selling different products, okay, but they are selling into the industry. So the industry behavior is, from the customer side, is very similar.
Yeah.
So where the synergies exist is around understanding how do we get heightened levels of loyalty, how do we get trust within our brands. So why does one of our brands have a very high level of trust with the customers? How can we replicate that across the other brands, albeit that they're selling different products? So as a business, we're sort of product agnostic,
Mm.
okay. But what we are is that we've got customer obsessed product specialists, and then the entire infrastructure behind these divisions is where we've been investing, as I said, in some of these central functions, still recognizing we're a divisional structure rather than a central structure. But each of these divisions have things like great finance teams to support them to grow, rather than a finance team from the center who's controlling the business, right? And then HR in particular, our motto is this equation that I must remind everyone, especially at IPO. I said, our business model is very simple. EE equals HC equals SS. And that is, an engaged employee generally leads to a happy customer, and a happy customer generally leads to a satisfied shareholder. Albeit, I totally appreciate where the share price is at the moment. But if you look at the resilience of the business, it starts because we've got engaged colleagues. And as a result, we've got happy customers, and you can see that in our top line. We're just waiting for the shareholders to be satisfied when the markets start to turn, and our valuations, etc., start to reflect more the resilience and long-term sustainability of our business. So that's kind of where we focus. We have to have divisional teams, because the autonomy of those teams is very important in them performing better than some of our competitors, because they're not centrally controlled. They're entrepreneurial. And I think if you remember, we have this entrepreneurial model where branch managers, general managers, it's their business. That's where the trading happens. They're closer to the customer. They're close to the suppliers as well. And it's a business that very much focuses on relationships with your colleagues, customers, suppliers. And then at the center, our job is to give direction and strategy, and make good investment choices.
Yeah, I love that sort of like I love that local accountability, responsibility, and it just breeds a really positive culture where you take ownership directly at the point of contact with the customer, rather than having to follow a protocol where you just lose your passion. So yeah, I'm with you, giving people that real sort of level of feel and sort of like love of the business in terms of
when you look at we've added 7 locations last year, okay. In those 7 locations are 7 entrepreneurs, again, who've got an opportunity to run their business, right, to effectively quote unquote own their business, right, be the emperor of their little empire. And that's the model. It's those guys who and girls who are key to our business. We won an award, the Builders Merchants of the Year award, for 6 to 20 locations. That was in our Laws Builders Merchants brand. One of our branch managers, a lady called Raina Reeves, she won the Branch Manager of the Year. Our focus is very much on what happens in those locations, what happens in terms of how they look after their customers. And that's the model that I think is long-term sustainable in our industry. It's a long-term sustainable strategy of our business, and we'll continue to focus on it.
Yeah. Well, if you ever decide to retire from Lords Group Trading, there's a job in the Premiership for you to manage one of these Premiership football teams, because they need a bit of passion and a bit of love for their business. That's for sure.
I think I'm much better off managing our lovely branch managers.
You do wonderful.
Highly paid footballers probably get the better of me.
You do a wonderful job at Old Trafford. Now, just looking a couple of years ahead, when are you hoping to sort of like achieve the sort of the strategic sort of like IPO, which was the half a billion, which you're not too far off on the turnover side.
We're not. I mean, I think, as I said, the market is 55 billion, right? And we're still less than 1%. People have asked me what happens when you become 1%. I said, well, we'll be less than 2%. So with fair wind, I think we'll hope to deliver this in FY24, of course, but it's dependent on wider macro. But what I will say, Paul, is that whatever the outcome, whether we're 10 million short, 10 million short, or 5 million above, etc. What I think I'd like to tell anybody who's an external stakeholder in our business is that we have a track record of growth, right? And therefore, it's only a matter of time before we cross the line. We meet the strategic aims that we have set out, right? And I think that's the important bit. This is a long-term sustainable business that has grown for over 30 years continuously. And it's seen volatile markets for whatever reason, whether it be the financial crisis, whether it's COVID and the supply chain issues that followed during and after COVID, whether it's the cost of living crisis, increasing in interest rates, and whatever may come next week or next year. We have such a large market and a model that continuously focuses on customer experience delivered through fantastic colleague engagement. And that is where the winning formula is. We've got good financial discipline. We've demonstrated that with debt reduction. We've got fantastic ability to consolidate in what is a fragmented market. But again, we show discipline. 2023, we had a number of opportunities, but unfortunately, with the market looking quite challenging in FY24, we had to make our own assessment of whether we should continue regardless, or whether we should just on a case-by-case basis make sure that if we're going to do something, we've de-risked. And again, we're only doing what we said we were going to do, is that we're disciplined, and we're again demonstrating discipline.
Okay, so yeah, we never lose that sort of passion and the long-term feel for the business. That's for sure. Just in terms of sort of like the sort of key messages, then obviously we've got the resilient side, and with M&A, what's the sort of the interpretation? Is it sort of like you're basically going to look at it on a case by case, but sort of probably dial back some of the acquisitions, unless it's really a sort of like a very, very attractive asset?
Dialing back, I mean, it's difficult to I mean, it's such an arbitrary comment. But the pipeline is active. We have engaged vendors. We have good opportunities available. But if you think about it, timing is everything. So the intent is clearly there. That's what we've done. We've done almost 15 acquisitions in the last 3 to 4 years. But we've got a really good track record of buying very well within a 4 to 6 range, and the average since IPO has been 4.8. Now that's what we call 4.8 maintainable. And when the markets are subdued, or the outlook is just uncertain for a short period, I think it makes sense to be disciplined, because, as I've always said, you can change everything about a business once you buy it. You can change the name, the people, the locations, the product it sells, the customers it sells to, but you cannot change the price. That's the one thing you can't change, 10 seconds after you hand it over, whatever amount of money at whatever multiple you've bought the business. And so therefore, you've got to be really, really confident that the future profitability, the opportunities, the market, etc., are indicating to you that this is a deal worth doing. And whilst we've got the opportunities, we will make acquisitions as soon as we feel that all of our criteria is met. And if it isn't met, then we're happy to wait until they are met. But that doesn't mean that we're not going to make an acquisition.
Yeah.
Right. It doesn't mean that the strategy has changed.
No, absolutely. Well, as I say, Another job opportunity for you there, Shanker, is to be a fund manager or to be an investor, because those are exactly the same. The rationale for doing really well in that job. And I would point just to investors that I did actually speak to a shareholder of Lords yesterday, Gervais Williams, and he described Lords as his best recovery stock for 2020 for 2024, and also just on valuation. I mean, you know, the shares are currently trading at about 42, 43p, and I've run the slide rule over today's trading statement, and my sort of fair value is between 70p and £1, just on very modest multiples, and sort of like a subdued recovery over the next few years. So it's very conservative forecast, but I think there's a lot of value in the actual business. So look forward in touching base again in for the finals in May, the Shanker.
Yeah. Hopefully that'll be another opportunity for us to see how the market's behaved in the first couple of quarters. Yeah.
Brilliant. Look forward to it. Thanks then, Shanker.
Great. Thanks, Paul.